How do you think tariffs will affect the economy? I mean, tariffs are actually, we've had a lot of experience with them. They're an act of war to some degree. How do you think tariffs will impact inflation over time? There are attacks on goods. The tooth fairy doesn't pay them. I mean, you always have to just end then what? You always ask that question about economics are and then what and so on. And in sight, no prices will be higher 10 years from now and 20 years from now and 30 years from now. And what do you think about what's happening in Washington right now about efforts? It's Washington. Yeah, it's, technology changes things, all kinds of things, but Washington is Washington. And the problem with politics is that if you tend to have to make tiny compromises as you go along, right now, I'm watching something unfold that I haven't seen since 2008. And if you were paying attention back then, if you had the capital and the courage to act when everyone else was frozen with fear, you could have positioned yourself for returns that seemed almost impossible. We're not in a financial crisis like we were then. The circumstances are different, but the opportunity, the setup, the dislocation between price and value, it's remarkably similar. Let me take you back to 2008 so you understand what I'm talking about. The financial system was imploding in real time. Bear Stearns collapsed. Lehman Brothers filed for bankruptcy. AIG needed a government rescue. The credit markets had completely frozen. Nobody could borrow money. Companies that had been around for a century were disappearing overnight. The stock market was in free fall. Fear was everywhere. Panic was the dominant emotion. And in the middle of all that chaos, I was looking for opportunities. Now, I didn't get everything right in 2008. Nobody did. I made some investments that didn't work out. But what I understood then, and what I'm seeing again now, is that when markets dislocate severely, when fear overwhelms rational analysis, you get chances to buy quality businesses at prices that make no sense. Prices that reflect a worst-case scenario that's far worse than what will actually happen. And if you can keep your head, if you can analyze businesses rather than just react to headlines, you can make investments that generate exceptional returns. In 2008, one of my best investments was in financial stocks that everyone had given up on. The market was treating all financials the same, as if they were all going to zero. But that wasn't reality. Yes, some banks were in serious trouble. Some deserved to fail. But others, the ones with good management and conservative balance sheets, were going to survive. They were going to come out stronger, and you could buy them at valuations that were absurd. I bought Wells Fargo. I bought Citigroup. These weren't speculative bets. They were calculated investments in businesses that were temporarily impaired but fundamentally sound. The key was distinguishing between temporary problems and permanent problems, between businesses that were broken and businesses that were just beaten down. That's always the key during dislocations. Most investors can't or won't make that distinction. They just sell everything and run for the exits. But if you can separate the wheat from the chaff, if you can identify quality that's been unfairly punished, that's when you make real money. So, what am I seeing now that reminds me of 2008? Several things. First, we've had a massive run-up in valuations over the past decade, particularly in growth stocks and technology. Money was essentially free for years. Interest rates at zero, everyone chasing returns, speculative excess everywhere. And now that era is definitively over. Interest rates have risen dramatically. The free money party has ended. And valuations are adjusting, sometimes violently. But here's the thing. When markets correct from excess, they don't just return to fair value and stop there. They overshoot. They always overshoot. Human psychology doesn't work in a balanced, rational way. Markets go from euphoria to despair, from greed to fear, from overvalued to undervalued. And right now, we're seeing sectors and individual stocks that have been absolutely demolished, not because the businesses are broken, but because sentiment has turned viciously negative. Look at what's happened to certain high-quality businesses over the past year or two. Companies with strong competitive positions, good management, reasonable balance sheets, they've been cut in half or worse. Why? Because they're in an out-of-favor sector. Because growth has slowed. Because investors are worried about a recession. These are temporary concerns getting priced as if they're permanent impairments. That's the opportunity. The second thing I'm seeing is a complete reversal in what's considered attractive. For years, investors didn't care about valuation. They didn't care about cash flow or earnings. They just wanted growth. The faster, the better. Profitability was optional. But now, suddenly, everyone wants safety. They want profitable companies. They want cash flow. They want dividends. This shift in sentiment has created a massive divergence in valuations between growth and value, between speculative and proven, between new and established. And this divergence always, eventually, reverts. Not necessarily all the way back, but it reverts. The pendulum swings too far in one direction, then it swings back. Right now, you can buy some truly excellent businesses, companies with decades of operating history and proven business models at valuations that are cheaper than they've been in years. Meanwhile, some speculative growth stocks that have never made money are still trading at premium valuations based on hope and narrative. That makes no sense, and it won't last. The third thing is the macro environment. We have inflation that's been more persistent than anyone expected. We have interest rates at levels we haven't seen in 15 years. We have geopolitical tensions everywhere you look. We have an election coming with massive uncertainty about policy. All of this creates fear and uncertainty. And fear and uncertainty cause investors to sell first and ask questions later. They reduce risk, they go to cash, they wait for clarity. But here's what I've learned over 30 years of doing this. By the time you have clarity, by the time everyone agrees the worst is over and it's safe to invest again, you've missed the opportunity. The best returns come from investing when things are still uncertain, when the picture is still murky, when most people are still scared. You have to be willing to act before you have all the answers. You have to be willing to take calculated risks when others are only seeing dangers. Now, let me be very specific about where I'm seeing opportunities, because I don't want this to be abstract. I'm looking at several areas very closely. The first is in what I'll call quality value stocks. These are established businesses with long track records, strong competitive positions, and reasonable valuations. They're not exciting. They're not going to be featured on the cover of magazines. But they're cash flow machines that are trading at prices that don't reflect their earning power. Think about certain industrial companies, businesses that make things the economy actually needs, infrastructure, equipment, components. These aren't tech startups or disruptors. They're companies that have been around for 50 or 100 years. They've survived wars and depressions and countless recessions. They know how to operate in tough environments. And right now, many of them are trading at single-digit multiples of earnings because everyone is worried about a recession or a slowdown in industrial activity. But here's the thing. Even if we do get a recession, which is certainly possible, these businesses aren't going to disappear. They're not going to go bankrupt. They'll have a tough year or two, sure. Earnings will decline, but then they'll recover like they always do. And if you bought them at 8 or 9 times earnings, you're going to do very well over any reasonable time horizon. You don't need to time the bottom perfectly. You just need to buy quality at reasonable prices and be patient. The second area is in selective financial stocks. Now, I know financials were the epicenter of the crisis in 2008, so people here buy financials and they get nervous. But the financial sector today is completely different than it was in 2008. Banks are much better capitalized. They have more equity cushions. Regulations are tighter. Lending standards are more conservative. The system is fundamentally more stable. And yet, financial stocks have been beaten down significantly. We had the regional banking crisis earlier this year that created panic. Depositors were worried about the safety of their money. Investors were selling bank stocks indiscriminately. But the reality is that most banks, especially the larger, well-managed ones, are fine. They're generating good returns on equity. They're sitting on massive amounts of capital. And they're trading at valuations well below book value in many cases. When you can buy a high-quality bank for 90 cents on the dollar of book value, when that bank is earning 15% returns on equity, when it has a fortress balance sheet, that's an attractive investment. You're buying assets for less than they're worth, and you're getting paid well through dividends while you wait for the market to recognize the value. These aren't speculative bets. They're investments in proven franchises at prices that provide a significant margin of safety. The third area, and this is where I'm spending a lot of time and capital right now, is in special situations. These are companies facing specific challenges that are temporary but have caused the stock to crater. Maybe they had a product recall that hurt sales. Maybe they made an acquisition that's taking longer to integrate than expected. Maybe they lost a key customer or had some litigation issue. These are the kinds of specific idiosyncratic problems that create opportunity. The market hates uncertainty. When a company has a problem, any kind of problem, Investors often assume the worst. They assume the problem will get worse, not better. They assume management can't fix it. They assume the business is permanently impaired. And the stock gets destroyed, often falling 50 or 60% or more. But if you actually do the work, if you dig into what's really going on, you often find that the problem is manageable. It's fixable. The business fundamentals are still intact, and the market has dramatically overreacted. These special situations require work. You can't just buy a basket of beaten down stocks and hope for the best. You have to understand each specific situation. You have to assess whether management is capable of fixing the problem. You have to evaluate the competitive position and whether it's been permanently damaged. But when you find the right situations where a temporary problem has created a massive valuation discount on a fundamentally good business, the risk-reward can be exceptional. Let me give you an example without naming the specific company. There's a business I've been accumulating that operates in a very stable, almost utility-like industry. They provide essential services with high customer retention and predictable revenue streams. They made an acquisition 2 years ago that was supposed to be transformative, supposed to open up new markets and growth opportunities. But the integration has been a disaster. Cost synergies haven't materialized. Revenue synergies are behind plan. The stock has fallen 70% from its highs. Now, most investors look at that and think, failed acquisition, terrible management, stay away. But when you dig deeper, what you find is that the core business, the original business before the acquisition, is doing just fine. It's generating strong cash flow. Customer retention is still excellent. The problem is entirely in the acquired business. And here's the key insight. Management has finally acknowledged the problem and is taking action. They've brought in new leadership for that division. They're implementing a restructuring plan. They're cutting costs aggressively. Is it going to work? I don't know for certain. Nobody does. But what I do know is that if they can get the acquired business to just break even, if they can stop the bleeding, the stock is worth double what it's trading at today based just on the core business. And if they actually succeed in turning around the acquisition, if they can capture even half the synergies they originally projected, the stock could triple or quadruple from here. That's an asymmetric bet. The downside is somewhat limited because the core business value provides a floor. The upside is substantial if the turnaround succeeds. Those are the kinds of opportunities I'm looking for. Now, none of this is easy. Let me be very clear about that. Investing during dislocations requires a completely different mindset than investing during calm markets. When everything is going up and everyone is making money, you can be sloppy and still do fine. You can buy mediocre businesses at high prices and the rising tide lifts all boats. But when markets are volatile and sentiment is negative, you have to be disciplined. You have to be selective. You have to really understand what you're buying and why. And you have to have the emotional fortitude to act when it's uncomfortable. That's the hardest part. When I was buying financials in 2008, everyone thought I was insane. The headlines were apocalyptic. Smart people I respected were telling me I was catching falling knives. There were days when I questioned my own judgment. But I kept coming back to the analysis. I kept asking, what's this business actually worth? What are the probable scenarios? What am I paying versus what I'm getting? And the math kept telling me to buy. You have to be able to separate your emotions from your analysis. Fear is a powerful emotion. When you're watching your portfolio decline day after day, when the news is uniformly terrible, when everyone around you is panicking, your natural instinct is to preserve what you have left, to go to cash, to wait it out. But that instinct, while completely natural, is usually exactly wrong from an investment standpoint. The time to preserve capital is when markets are euphoric and valuations are stretched. The time to deploy capital is when markets are fearful and valuations are compressed. Let me talk about some specific characteristics I'm looking for in investments right now. First, strong balance sheets. This is absolutely critical in uncertain times. Companies with too much debt are vulnerable. They might not survive a severe downturn. But companies with strong balance sheets, with lots of cash and manageable debt, they not only survive, they thrive. They can invest when competitors are retrenching. They can gain market share. They can make opportunistic acquisitions. Financial strength creates options, and options are valuable. Second, proven business models with long operating histories. I'm not interested in speculative bets on unproven business models right now. I want businesses that have demonstrated they can make money through multiple economic cycles. I want to see a track record of generating cash flow in good times and bad times. This isn't the environment to be betting on startups or turnarounds or companies that are still trying to prove their model works. I want proven cash generative businesses. Third, reasonable valuations based on conservative assumptions. I'm not trying to buy at the absolute bottom. I'm not trying to catch the exact low tick, but I want to pay prices that give me a margin of safety. If I'm buying a business at 10 times normalized earnings, I want to be confident that normalized earnings aren't going to be permanently impaired. I want to know that even if things get worse before they get better, I'm still buying value. Fourth, management teams that I trust. This is huge. In uncertain times, management quality matters enormously. Good managers make good decisions. They allocate capital wisely. They don't panic. They stay focused on the long term. Bad managers make bad decisions. They waste capital. They make desperate moves. They destroy shareholder value. So I'm very selective about management. I want teams with track records, with skin in the game, with incentives aligned with shareholders. And fifth, catalysts. I want to understand what could unlock the value. Maybe it's a turnaround plan that's starting to work. Maybe it's an asset sale that will simplify the business and return cash. Maybe it's a new product cycle. Maybe it's just the market eventually recognizing quality that's been overlooked. But I want to have some view on why this stock won't just sit at a depressed valuation forever. What's going to cause it to re-rate higher? Now, let me address the biggest objection people always have to this approach. They say, what if things get worse? What if we do go into a deep recession? What if there's another crisis? Shouldn't I wait until the coast is clear? And my answer is always the same. Yes, things could absolutely get worse. I'm not predicting they won't. Markets could fall further. We could have more volatility. But here's the thing. If you wait for perfect clarity, if you wait until everyone agrees the worst is over, you will miss the opportunity. The best investments are made when the outcome is still uncertain, but the odds are in your favor. Not when the outcome is certain. Certainty gets priced immediately. Uncertainty creates opportunity. So the question isn't whether things might get worse. The question is whether you're being compensated for taking that risk. And right now, in many cases, you are. You're buying businesses at prices that already assume things will be quite bad. If they're just moderately bad instead of terrible, you'll do well. If they're actually not that bad, you'll do very well. This is about probabilities and expected values, not certainties. I can't tell you with certainty what will happen to the economy or the market over the next year. Nobody can. But I can tell you that when you buy quality businesses at depressed valuations, when you have a margin of safety, when you have a 3 to 5 year time horizon, the odds are strongly in your favor. History shows that clearly. Every major market decline, every period of distress and dislocation has been followed by a recovery. And the people who invested during the distress, who had the courage to act when others were frozen, they made extraordinary returns. Let me talk about position sizing and portfolio construction because this matters. I'm not suggesting you go all in on any single idea. That would be reckless. Even high conviction ideas can be wrong. The market can remain irrational longer than you expect. Individual companies can have problems you didn't anticipate, so you need diversification. But diversification, for me, doesn't mean owning 50 or 100 different stocks. That's what I call diversification. You're so diversified that you can't possibly outperform. I typically have a concentrated portfolio of 10 to 20 positions. Each position is meaningful, usually 5 to 10% of the portfolio, sometimes more if I have very high conviction. This gives me enough diversification that no single position can destroy me, but enough concentration that my best ideas can really move the needle on performance. And critically, each position is something I actually understand, something I've researched thoroughly, something where I have an informed view on the value and the opportunity. I also think about correlation between positions. I don't want 10 different positions that are all going to move together. If I have exposure to financials, maybe I also have exposure to healthcare or industrials or consumer goods, different sectors that won't all be hit by the same problems at the same time. This isn't perfect diversification, but it's smart diversification. It's about reducing unnecessary risk without diluting returns. And I think about time horizon. Everything I'm buying now, I'm prepared to hold for 3 to 5 years minimum. maybe longer if the thesis is playing out. I'm not trading. I'm not trying to flip these for quick gains. I'm making investments in businesses that I believe will compound value over time. That long-term orientation is critical because it allows me to look past short-term volatility. It allows me to focus on business fundamentals rather than stock price movements. Let me share some thoughts on sizing positions within the portfolio. My highest conviction ideas, the ones where I've done the most work and I have the most confidence, those might be 8 or 10% positions. Medium conviction ideas might be 5%. Lower conviction ideas, maybe I'm just starting to build a position or I'm still doing work, those might be 2 or 3%. This way, I'm putting more capital behind my best ideas while still maintaining appropriate diversification. I also think about adding to positions over time. I rarely buy my full intended position size immediately. I'll start with maybe half the intended size, then add to it as I get more comfortable and as the thesis develops. If the stock goes down, that's often an opportunity to add more at better prices, assuming nothing has changed with the fundamental thesis. If it goes up quickly, maybe I don't add more, maybe I even trim some. This dynamic position sizing helps me manage risk and take advantage of volatility. One more critical element is having dry powder, having cash available to deploy when opportunities arise. I never want to be fully invested to the point where I can't take advantage of new opportunities. If I see something compelling, I want to be able to act. Maybe that means I'm holding 10 or 15% in cash at all times, maybe more during uncertain periods. This cash drag will hurt performance during bull markets when everything is going up, but it provides optionality during dislocations, and that optionality is valuable. Now let me talk about some of the psychological challenges of this approach because they're real and they're significant. The first challenge is patience. When you invest during dislocations, when you buy businesses that are out of favor or facing problems, you have to be prepared for the investment to work slowly. It might take 6 months or a year or even longer for the market to recognize the value. During that time, you're just sitting there holding a position that might not be doing anything or might even be going down further. That tests your patience and your conviction. The second challenge is volatility. These opportunities I'm describing, they're not stable, low volatility investments. They're going to move around a lot. Some days they'll be up 5%, other days down 5%. You have to be able to stomach that volatility without panicking. You have to be able to look at your portfolio statement and see a position down 20% without immediately thinking you made a mistake. That's hard for most people. The third challenge is being wrong. Even with thorough research and careful analysis, you're going to be wrong sometimes. Some investments won't work out. The turnaround you expected doesn't happen. The problem you thought was temporary turns out to be permanent. The management team you trusted makes bad decisions. You have to be able to acknowledge when you're wrong, cut your losses, and move on. That's crucial. Holding on to losing positions, hoping they'll come back, is one of the biggest mistakes investors make. The fourth challenge is opportunity cost. When you invest in out-of-favor, undervalued situations, you're often giving up the chance to invest in whatever is currently working, whatever is going up. You watch other stocks or sectors rally while your holdings do nothing. That's psychologically difficult. You start second-guessing yourself. You wonder if you should just give up on value and chase momentum like everyone else. You have to resist that temptation. But here's what I've learned. If you can handle these psychological challenges, if you can be patient and disciplined and objective, the rewards are significant. The times when I've made the most money in my career have been during periods of dislocation and distress, not during easy bull markets when everything goes up. Those are nice, but the real wealth is created during difficult times when you're willing to take calculated risks that others won't take. 2008 was transformative for me as an investor, not because I got everything right, I didn't, but because I proved to myself that I could act when others were paralyzed. I could analyze businesses when others were just reacting to fear. I could take meaningful risks when the prevailing wisdom was to hide in cash. And the returns from those investments were exceptional. Not just good, exceptional, life-changing. And that's what I'm preparing for now. I don't know exactly when the opportunity will crystallize. It might be happening right now. It might be 6 months from now. It might be a year from now. But I know it's coming because these cycles always play out the same way. Fear gets overdone, valuations get compressed beyond what makes sense. Quality businesses get thrown out with the garbage. And if you're prepared, if you have capital, if you have conviction, you can make investments that will compound for years. So I'm building a list of opportunities. I'm doing deep research on businesses I want to own. I'm maintaining cash reserves so I can act decisively when the time is right. I'm preparing mentally for the discomfort of buying when everyone else is selling. And I'm reminding myself of the lessons from 2008 that the best opportunities come during the worst times. That fear is usually overdone. That quality businesses bought at the right price will compound wealth over time. This isn't about market timing. I'm not trying to call a bottom. I'm not trying to predict what the market will do next week or next month. I'm identifying quality businesses trading at valuations that provide a margin of safety, and I'm prepared to build positions in those businesses over time. Some I'm buying now, others I'm watching and waiting for better entry points, but I'm engaged, I'm active, I'm looking for opportunity while others are only seeing risk. This setup reminds me of 2008, not because we're in a financial crisis, we're not, but because of the fear and uncertainty and the gap between price and value. Because of the opportunities to buy quality at discounts, because of the chance to make investments that could generate exceptional returns over the next 3 to 5 years. These opportunities don't come around often, maybe once or twice a decade. When they do appear, you have to recognize them and act. That's what I'm doing now. That's what I did in 2008, and that's what I believe will work again. I want to share something else that's critical about how I approach these situations. It's not just about finding cheap stocks or beaten down sectors. It's about understanding the narrative and why it's wrong. Every major market dislocation comes with a dominant narrative that explains why things are terrible and why they're going to stay terrible or get worse. In 2008, the narrative was that the entire financial system was going to collapse. Banks were all insolvent. We were heading into another Great Depression. The world as we knew it was ending. And you know what? Parts of that narrative were true. The financial system was under severe stress. Some banks were insolvent. We did have a major recession, but the narrative went too far. It assumed everything would fail. It assumed there was no way out. It assumed the worst case across the board. And when everyone believes the worst case narrative, when that gets fully priced into stocks, that's your opportunity. Because reality is usually not as bad as the worst case. And when reality turns out to be merely bad instead of catastrophic, stocks can rebound dramatically. Right now, we have several competing narratives that are creating fear and driving valuations down. There's the inflation narrative, that inflation is going to stay high and destroy purchasing power and force the Fed to keep rates elevated for years. There's the recession narrative, that we're heading into a deep economic downturn that will cause massive job losses and corporate bankruptcies. There's the geopolitical narrative, that tensions between major powers are going to escalate into conflicts that disrupt global trade and supply chains. Are any of these narratives completely wrong? No. They all have elements of truth. Inflation has been persistent. We could have a recession. Geopolitical tensions are real. But I think the market is pricing all of these worst cases simultaneously. It's assuming high inflation and a deep recession and geopolitical disasters all happening together. That's unlikely. More likely, we muddle through. Inflation comes down gradually, we have a mild recession or avoid one altogether. Geopolitical issues get managed without catastrophe. And if that more moderate scenario plays out, if we avoid the worst case outcomes that are priced in, stocks in many areas should do very well. This is where independent thinking becomes absolutely essential. You can't just follow the consensus. You can't just believe whatever narrative is dominating headlines. You have to look at the actual data. You have to think probabilistically. You have to ask yourself, what's really likely to happen versus what everyone fears will happen? That gap between fear and likely reality is where opportunity lives. Let me give you a specific example of how I think about this. There's a lot of fear right now about commercial real estate, particularly office buildings. The narrative is that work from home is permanent, that office space demand has been permanently destroyed, that building values are going to crater, and that this will cause a wave of defaults that damages bank balance sheets. This narrative has crushed the stocks of companies with exposure to commercial real estate. But when you actually dig into the data, what do you find? Yes, office utilization is down from pre-pandemic levels. Yes, some buildings in some cities are struggling to maintain occupancy, but the market is pricing this as if every office building is going to be worthless. That's not realistic. Quality buildings in good locations are still leasing space. Companies are still signing leases, just maybe for less space or with more flexibility. And importantly, very little new supply is being built, which means over time, as the economy grows and companies need more space, the existing buildings will have pricing power. So there are opportunities in companies with exposure to commercial real estate, but you have to be selective. You can't just buy anything related to the sector. You want companies with high quality assets in strong markets. You want companies with reasonable debt levels that can survive a difficult period. You want companies where the current stock price is pricing in a catastrophic scenario that's unlikely to occur. When you find those situations, when fear has pushed valuations to extremes, that's worth investigating. Another critical element of my approach is understanding capital allocation. When I invest in a company, I'm not just betting on the current business. I'm betting on what management does with the cash the business generates. Do they reinvest it wisely in growth opportunities? Do they return it to shareholders through buybacks and dividends? Or do they waste it on empire building and value-destructive acquisitions? Companies that allocate capital well compound value over time. A business that generates a 15% return on invested capital and reinvests intelligently can compound shareholder value at very attractive rates. But a business that generates strong cash flow but wastes it on bad investments or excessive executive compensation, that business won't create value even if the core operations are good. So I spent a lot of time evaluating management teams and their track records of capital allocation. This is especially important during dislocations when companies have more capital allocation options. Do they pay down debt to strengthen the balance sheet? Do they buy back stock at depressed prices? Do they make opportunistic acquisitions of distressed competitors? The best managements make the right moves at the right times. They strengthen their positions during difficult periods and emerge from crises in better competitive shape than they entered. Those are the companies I want to own. I also want to talk about the importance of staying flexible and adapting your views. One of the biggest mistakes investors make is falling in love with their ideas. They make an investment based on a certain thesis, and then when the facts change, when their thesis is proven wrong, they don't adjust. They hold on, hoping they'll be proven right, eventually. That's dangerous. You have to be willing to admit when you're wrong and change course. I've made this mistake myself more times than I'd like to admit. I've held positions too long because I was emotionally attached to being right. I've averaged down on losing positions that kept getting worse. I've ignored warning signs because they didn't fit my narrative. Those experiences were painful, but they taught me the importance of intellectual honesty and flexibility. The market doesn't care about your opinion or your ego. It doesn't care if you're right or wrong. All that matters is what actually happens. So now, when I make an investment, I also clearly define what would cause me to sell, what would indicate that my thesis is wrong, what would suggest the business is impaired in a way I didn't anticipate. Having that framework established up front makes it easier to make rational decisions later when you have money on the line and emotions are running high. It forces you to be honest with yourself about whether the investment is working or not. Let me talk about another aspect of preparing for opportunities, which is building knowledge and expertise in specific areas. I can't be an expert in every industry or every type of business. Nobody can. But I can develop deep knowledge in certain sectors or business models where I've spent years studying and investing. And when opportunities arise in those areas where I have expertise, I can move quickly and with confidence because I already understand the dynamics. For me, one area where I've developed significant expertise is consumer brands and retail. I've studied these businesses for decades. I understand what makes a strong brand. I understand retail economics. I understand customer behavior and market positioning. So when there's dislocation in consumer stocks, when great brands are getting beaten down because of temporary problems, I can evaluate those situations quickly. I know what questions to ask. I know what metrics matter. I know what separates winners from losers. This specialization has been incredibly valuable. It doesn't mean I only invest in consumer stocks. I don't, but having areas of deep expertise gives me an edge in evaluating certain opportunities. And during dislocations, when you need to make decisions without perfect information, having that expertise and pattern recognition is crucial. You can't research everything from scratch during a crisis. You need some foundation of knowledge to build on. I think this is something individual investors should think about too. Pick a few areas where you're going to develop real expertise. Maybe it's technology because you work in the industry. Maybe it's healthcare because you're a doctor. Maybe it's a sector you're just fascinated by and willing to study intensely. But develop real knowledge in those areas so that when opportunities arise, you can evaluate them competently. That's much better than trying to be a generalist who knows a little about everything but not enough about anything to make informed decisions. The other thing I want to emphasize is the importance of intellectual humility. Markets are humbling. No matter how smart you are, no matter how much experience you have, you're going to be wrong sometimes. You're going to miss things. You're going to make mistakes. Accepting that, embracing that, is essential to long-term success. The investors who get in real trouble are the ones who think they have everything figured out, who aren't open to being wrong, who let their ego drive their decisions. I try to always be asking myself, what am I missing? What could go wrong that I haven't thought of? What does someone who disagrees with me see that I don't see? This doesn't mean I second guess every decision or lack conviction, but it means I'm constantly stress testing my ideas and looking for holes in my logic. It means I'm open to new information and willing to change my mind when warranted. That intellectual humility has saved me from some very bad decisions over the years. As I prepare for what I believe will be significant opportunities over the next year or two, I'm also thinking about time horizon and liquidity. These aren't short-term trades. I'm not looking to flip stocks for quick profits. I'm making investments with a 3 to 5 year view, maybe longer. That time horizon is important because it allows me to be patient. It allows me to ride out volatility. It allows me to focus on business fundamentals, compounding over time rather than worrying about monthly or quarterly stock price movements. And I'm thinking about liquidity in my portfolio. I want to be invested in companies where if I need to exit, I can do so without moving the market significantly. This matters more as your capital base grows. When you're managing tens of millions or hundreds of millions, you can't just buy tiny microcap stocks or illiquid situations. You need companies with enough trading volume that you can build and exit positions efficiently. This is a constraint, but it also forces discipline around position sizing and stock selection. The final thing I'll say is this. Preparing for opportunities, like we're seeing now, isn't just about having capital and doing research. It's about mental preparation. It's about training yourself to act when it's uncomfortable. It's about building the emotional resilience to buy when others are selling, to hold when others are panicking, to trust your analysis when the crowd is screaming that you're wrong. That mental and emotional preparation is just as important as the financial and analytical preparation. I practice this constantly. When markets are volatile and my positions are down, I force myself to review the original investment thesis. Is it still intact? Has anything fundamentally changed? If the answers are no, and the business is still solid, then the decline is just noise. It's an opportunity to buy more, not a reason to sell. Training yourself to think this way, to separate business value from stock price, to be rational when others are emotional, that's the real edge in investing. So as I look at the landscape today, as I see quality businesses at reasonable valuations, as I see fear dominating sentiment, I'm reminded of 2008. I'm reminded of the opportunities that emerged from that chaos. I'm reminded that the best investments are made when it's hardest to be invested, and I'm preparing mentally and financially to take advantage of what I believe will be exceptional opportunities to build long-term wealth